Hello everyone, Kevin Coyle here with John Finley, November 2016 market update. John, you don't need to repeat all the sound bites we've been hearing post-election, but perhaps a couple of comments on your thoughts.
Well, equities have certainly in the U.S. have jumped post-election, and a lot of that is around some of the campaign rhetoric that we heard from Mr. Trump on infrastructure spending, deregulation. So you see the results of that in the financial stocks doing well, materials, industrials, energy doing well.
Well, deregulation, energy, infrastructure spending, industrials,
sure,
and deregulation as well as some of the spending which raise interest rates, which is positive for banks because of the margin they make on the spread. So low interest rates is not a positive for banks. So you've seen banks move quite nicely since then. Maybe come comment briefly too is that we were maybe up 2 or 3, 4% year to date before the election. Maybe we're up another 3%, 7% now. So it's not like the world's been turned on its end. We're still really in a slower growth environment, and maybe some of this recent market returns has to do with the election, but also with the fact that third quarter earnings were positive, and we are seeing some faint signs of growth here.
Right, and that's independent of the election. So
right,
whatever you might think about a Republican administration being more business friendly, the trend in corporate earnings was definitely getting better anyway.
So you go back to 2014, the end of the year there, compared to where we are now, even before the election, the market was up marginally, and that really had to do with earnings being flat, right? Energy related, the dollar related. So if we see some growth going forward here, at least some continued expansion here, that could bode well for the markets moving forward. General comments in terms of your thoughts of where we are now and where we're heading, John?
Well, we have to see how the policies in Washington play out. The trends that you're seeing, not just in the U.S. but around the world, around deglobalization, and that's in long term, in my opinion, not a good thing. Trade wars and protectionism are never a good thing, and so that actually accounts for why small cap stocks have done so well since the election. But we'll have to see how it actually plays out, but I think the underlying factors globally as well as the U.S. are population growth and productivity are both very low. Those are the two drivers of economic growth.
And the 20,000-pound elephant in the room is just the accumulated levels of debt we have, which makes it continue to make it difficult to have that marginal ability to adapt to what's going on. So you mentioned small cap stocks, U.S. They're not doing their sales in overseas markets, so they're maybe insulated from a trade war. But then you also talk about other areas where there might be opportunity going forward. Emerging markets have been hit negatively post-election because they would be impacted negatively from a possible trade war. So things to look for as we kind of try and balance this way and maintain our allocations as we move forward. In the meantime, we'll see you next quarter, and have a happy holiday.